Hello and welcome back to The Note, and may I apologise in advance for the state of my voice. I'd like to talk about emerging market ETFs. A column I wrote recently about this has had quite a lot of feedback, both positive and negative, because I tried to suggest that they may not be the best way to invest in emerging markets, and they might even be having some negative effects. Let me try now to take you through this case as best as I can. Now, to start off with, if we take a look at the flows from the US going into ETFs that cover emerging markets and to conventional open-ended funds that you can't trade through the day like an ETF, but only once a day, and into actively managed funds, you can see that plainly at the margin over the last 5 years post-crisis, ETF flows have really dominated the picture, and they have been very, very much more volatile than flows into actively managed funds. You can see there's 6 separate quarters in the last 5 years when there have been outflows from ETFs in the emerging markets, none at all from actively managed emerging market funds. Plainly, at the margin, this suggests that ETF money is flighty. Perhaps it's only going into emerging markets in the first place because it has that extra liquidity that ETFs provide, that you can pull it out very swiftly. And plainly at the margin, this implies that ETF flows are stoking the extra volatility that we've seen in emerging markets. Now, what about the case for the investment return that you get from an ETF? Normally, if we're talking about developed markets, ETFs have now got to the point where they can match their index almost perfectly. But as we can show you here, if you look at the iShares MSCI Emerging Markets Index, almost universally known by its ticker symbol of EEM, and you compare it to its index, you can see that over the last decade, there really is quite a significant tracking error there, more than 0.5 percentage point per year. That's getting a little less in recent years. I've talked to the manager of that ETF about it. But the fact remains that there are many markets which are harder to access. They trade at different times. It's very hard to keep that tracking error down. That is an area of some concern. The second point, which is fascinating to me, is that ETFs also have a problem beating actively managed funds. This is even though ETFs are virtually costless, assuming you've already got a brokerage account, whereas actively managed funds tend to charge a very big fee. In developed markets, as I've said many times before, that tends to be an insuperable advantage for passive funds. But if we now take a look at how actively diversified EM funds have done, according to Morningstar, compared to EEM, compared to the main iShares ETF, over the last 1, 3 and 5 years, every time there is a significant advantage for the actively managed funds there. They are actually earning their fees. Now, why might that be? Well, it's probably because emerging markets continue to be more inefficient than developed markets. It's easier to actually find bargains and outperform. There's another aspect to it, though, which is that logically you have to pay something for the liquidity that people plainly want, given in emerging markets, given the way that they are piling into ETFs rather than other vehicles. You could look at that gap in performance as the premium you pay for liquidity. And if we were to take the step further and look at hedge funds, which are obviously very illiquid indeed, their performance has been dramatically better than this in recent years. Now, a further point about liquidity in emerging markets is that very much against what you might expect, the more liquid a stock is, or a country is, or a sector is, then also the more volatile it is. I can illustrate that for you with this chart here from Emerging Global Advisors in New York. The bars show you the standard deviation. That's the basic coordinate of how much returns tend to vary over time. And you can see that if you strip out the most liquid markets, South Korea, Taiwan, and the BRICS, Brazil, Russia, India, and China, those remaining markets tend to be much less liquid, but they are actually less volatile. If we look at this in terms of beta, the extent to which sectors or stocks tend to move in response to a move in the overall index, similarly, the less liquid markets actually show a much lower beta, while the BRICS are actually more volatile. You could say that you'd get similar results if you looked at this in sectors. The less liquid sectors, such as the domestic plays, tend to be less volatile than the big, often formally nationalized industries that tend to make up the bulk of emerging market indices. Now, I would argue, being perhaps somewhat old-fashioned, that emerging markets ought to be a game for the patient, for the long term, and that perhaps you shouldn't be aiming to be so liquid anyway. But there plainly is a cost to that liquidity, both to investors and, I would argue, for the emerging markets.